Hello and welcome. You're listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And my name is Goose. And on today's show, Gabi and I talk about how to manage interest rate rises in your property portfolio. So we looked at it from a couple of different angles. We looked at it from the mindset perspective, how to think about how to operate in this environment, but also some tips and kind of ideas on how you could potentially think about approaching it. Everything from expanding your portfolio to make up the shortfall through to small tactical things, such as potentially doing a renovation, looking at rental increases, putting cash in offset, loads of different stuff like that. So if you want to know all of this kind of stuff, then of course you've got to listen to the whole episode. I think it was pretty good because currently right now, I genuinely believe that we're in a pretty good environment, but we can get caught and fixated on small things that don't make necessarily big impacts on our long-term strategy. So if you want to know how to succeed in this environment and how to change your thinking a little bit so that you too can adapt and be successful regardless of what the interest rate environment is doing, then this is the episode for you. So without any further ado, let's get stuck into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. You're joining Goose and Gabi today. Gabi, how are you?
I'm excellent. How are you?
I'm very well, thank you. Very, very well.
Wonderful.
How you feeling?
I'm okay. Yeah, I'm okay. I was feeling a bit crook yesterday, to be transparent with everyone, but I've woken up today going, those 17 hours of sleep I managed to randomly pull out yesterday have helped. So yeah, I'm feeling okay.
Okay, well that's good. I'm good. I'm excited actually. There's a lot to be excited about personally, I think. And I might actually dig into that. So last time we spoke, I said something at around in the episode, I said something along the lines of I think that we're going to go into a recession or something like that. Mm-hmm. And I kind of want to clarify that. I thought about it afterwards. I thought about it after we recorded, and I was like, did I actually clarify my intent with that statement? And I'm not sure that I did. And I thought it would be worth just quickly before we jump into the content for this episode, just kind of getting some shape around that. What I mentioned in the last time we spoke is I said I was pretty confident that rates will come down in the next 24 months, right? I'm still quite confident about that. But also said, I think it's likely that we're going to go into a recession. And I think that could actually sound quite alarming to people.
Yeah, probably.
But so I kind of want to clarify a couple of things because number one, firstly, I don't have a crystal ball, right? So sometimes I get excited and I'm like, yeah, this is going to happen. And it's like, well, maybe it might happen, but it also might not. But also the other point that the point that I was trying to make is that there's a massive difference between a technical recession, which is quite possible. It's quite possible. How likely is it? I don't know. But a technical recession is very different from what we would think about as a real recession, right? Where people are losing their jobs and businesses are failing and everything's kind of going bad. And the point that I was making is that in the process of speeding up and slowing down an economy, there's probably going to be a transition moment where at some point you'll move from going fast to going slow or try and rebalance that equilibrium. So on a technical GDP basis, we might actually technically hit the big R. But I actually really don't think that there's and I'm actually kind of less confident that is going to happen now because there's so much good stuff going on out there in the economy that people just aren't talking about, and that I think is really, really important because consumer confidence is at basically the same levels as the GFC, right? GFC, we thought the whole financial world was going to collapse. Consumer sentiment's almost as bad as the start of COVID, April 2020, which is crazy. But the fact of the matter is we have record low unemployment rates, the lowest, I think it's 3.4% unemployment rate now, which is crazy, right? There's record levels of business savings and personal savings, so cash sitting in bank accounts. So no one's gone broke out there. Everyone's got jobs. Everyone's got savings. We've got the lowest business insolvency rate in 35 years. That's crazy. So businesses are going good too. Business insolvency is down, and international migration's pouring in as well. So in real terms, I don't think that there is an economic risk to Australia in a meaningful sense. Inflation is a challenge, right? But I don't. So I kind of wanted to clarify their statements because I felt like I might have actually come across as saying, yeah, okay, I think things are going to go bad. And that was really not what I meant at all by that statement. Does that kind of clear things up, Gabi? What do you think?
Yeah, it does. Yeah. And I think it's important that you clarified it, right? Because people interpret things their own way. And I know you, and I know that you get excited and you want to share ideas very confidently and kind of paint a picture very clearly, because that's what helps people move forward. And I think, like, just on the consumer sentiment piece, like, consumer sentiment in its essence is like the mindset of the masses, right? So if consumer sentiment is low, what that actually means is that as a collective mindset, everyone is thinking pretty negatively about the financial environment and the economy and everything. And so when consumer sentiment is low, it's really hard to, I don't even know what I was going to say then.
Well, I mean, that's fine. I mean, like, let me wrap it up for you, because, like, when you're right, when consumer sentiment is low, that basically means that everyone is feeling pretty shitty, right? Everyone's got a pretty low, a low opinion of what the future looks like. They feel uncertain. They're keeping cash in banks. They're starting to get scared because they don't know what the future looks like. And I don't want to sound like a kind of like tinfoil hat kind of beating the drum about the don't listen to the media, But I mean, look, the reality is, if you look at the facts, things are actually just a lot better than the kind of like doomsday story that we keep getting told. Yes, interest rates are going up, but interest rates aren't the be all and end all. Right? There's loads of other factors out there. And I mean, like, just another example is that the media keeps saying things that, like, oh, the property market's crashing, but we actually did an analysis, and over the last 6 months, 53% of suburbs nationwide have consistently grown over the last 6 months. 53% of suburbs have consistently grown over the last 6 months. Sorry, is what I meant to say. So more than 50% of suburbs are growing consistently, yet the media is saying that everything's going bad. And so the point that I'm trying to make is that there's actually underlying all of this kind of noise and negativity, there's a really good news story. And I think it's our obligation to try and show people that, because, you know, like, if you had a friend who was feeling a bit depressed and a bit negative, what would you do? You'd actually try and point out, like, all of the reasons that life is great, and they're true reasons. This isn't like a straw man kind of conversation or argument where it's like, well, if we just look at these 2 or 3 things that are nice, we can pretend like everything's great. It's like, well, in actuality, the body of evidence suggests that most things are actually going really, really good, but there's 1 or 2 things actually that can give people a little bit of stress, right? And I think that one of the main things one thing I'd like to really talk about now, because it's going to start to lead into the conversation we really want to have today, which is about interest rates and cash flow, is there's 2 main characteristics that I've learned. You know, I read lots of books and I've spoken to lots of people, and there's 2 kind of main characteristics that seem to separate the most successful from the least successful. And number 1 is time horizon. You know, the most successful people are thinking in years and decades, right? Typically decades. That's the time horizon for their goals, their big goals. They're shooting. So they tend not to worry about, minute fluctuations or deviations or emotional, volatility and all of that kind of stuff, because they've got a plan. They're executing their plan over the long term, and it makes sense because it's a good plan and it's a good strategy, right? And that's how they get to their goals. The least successful are thinking like, oh my God, what's going to happen to me tomorrow, right? And the other thing is adaptability. And everyone thinks that Charles Darwin said, something along like it's survival of the fittest. Everyone's heard that. Oh, it's survival of the fittest. That is not what he said. The actual quote, and I quote, is, "It is not the strongest of the species that survive, nor the most intelligent, but the ones most responsive to change." That is the actual quote, right? So it's actually survival of the most adaptable, right? So the most successful people have got a longer term time horizon, and they're more adaptable, which means that they're more emotionally stable as well, because they look at all of these things and the changing environment around them, and they don't lose their head. They said, that's cool. We're still going that way. Let's just like dance around a little bit. So in an environment where interest rates are going up, right, which they are, like, that's cool. What is the biggest impact for property investors? Cash flow is kind of the biggest impact, right? Yeah. And let's be real. Like, we can kind of talk about the fact that, hey, everything's going great. The economy is actually going good. There's lots of stuff to be grateful for. There's a lot of really good positive news stories, particularly in the property market. Lots of markets are growing actually very, very well. More markets are growing than are declining, right? So it's actually more upside than downside. But let's not try and dress up the fact that rising interest rates do impact cash flow. And so what I thought, off the back of our last conversation, where we talked about interest rates sort of versus inflation, and we talked about the cost of real inflation and all of that kind of stuff, I thought that this could be a really cool episode for us to really dig in to go, okay, well, pragmatically, how do you adapt? How do you adapt to this environment? You want to be successful? Great. You're not going to lose your head. Cool. You either want to keep your portfolio and you want to keep it humming, or you might want to add to your portfolio and keep growing your portfolio, which personally I think is a really good idea. And we can kind of talk about why that's a good idea in a moment. But how do you adapt so that you can be successful in this environment? So what do you think, Gabby? You ready for that?
I am. Yeah. So it's kind of like, yeah, if you are deciding, is this a good time for me to be buying if you haven't invested in property before, considering cash flow, because a lot of people, I think, based on this, mindset of the masses, people are scared to invest in property because, they're scared that repayments are just going to keep going up and up and up, and they're not sure that they can sustain that. Or they have a portfolio and they're not sure if they're going to be able to hold it. They're not sure if they're going to be able to add to it, again, with these like unknown looming interest rate creep. So this is kind of like, what are some practical things you can do and put in place to think about that?
Cool. Sounds good. What's your first tip? How do you think people should think about this?
Well, I think to start, it's usually like take a bit of a stock of where you are at. Do a bit of a recce on what your current situation actually is, as it is today. Like if you don't have all of your stats together of like, actually, how much do I pay in repayments? How much net cash flow am I actually, like, am I slightly positive? Am I slightly negative? Am I very positive? Am I very negative? Figure out what that dollar amount is. That's step one, if you haven't already done that. But then it's also being able to model in like, okay, what am I actually scared of? And what does that look like in numeric terms? So like, I'm scared that interest rates are going to go up and up and up and up and up. What does that look like as a dollar amount? And actually being able to model in like, okay, if interest rates increase by 3%, what does that look like and how does that impact my cash flow? And if you plug it in as though nothing else in your strategy changes, if you just plug in like, okay, the only thing that changes is that rates, double, however hard you want to model, then you can at least define what it is you are trying to strategize around. Like if you have, okay, the dollar amount is an extra $500 a month or something, at least then you know what that is. And I think like you're only ever fearful if you don't know what the enemy is. Whereas if you have a clear idea of what the enemy is, then you know what you can prepare for and what you can strategize around how to conquer. So I think step one is really like defining what that enemy is, for lack of a better word, defining what it is that you are trying to prepare for before you go and freak out and go, okay, I need to try this, I need to try this, I need to try that. Just figure out like, what am I doing first step? Like, what is my game plan here?
Yeah, I think it's a really great point. I think it's a really great point that you first need to identify what the enemy is in order to then work out how to conquer the enemy. I think that's an awesome sentiment, because you're right? Because when there's like this big esoteric interest rates are rising, cash flow is going to go down, how scary. But like if you actually break it down and go, okay, what does that actually mean? Is it $1,000 a year? Is it $2,000 a year? Is it $3,000 a year? Is it $10,000 a year across the portfolio? Is it $20,000 a year across the portfolio, depending on it? This is really, really important, right? Because if you understand the quantum, then you can prescribe the right solution. Because otherwise, what you might end up doing is prescribing the wrong solution for the wrong problem. You might prescribe a $20,000 solution to a $2,000 problem, which might not be necessarily a bad thing, but you might also prescribe a $2,000 solution to a $20,000 solution, which would maybe get you nowhere and cause you more stress and distress, right? So,
or you also prescribe a solution just to kind of soothe your own emotional response in the short term. Like you're like, shit, need more cash flow, do something immediately that's going to immediately benefit your cash flow, but then that might fizzle out. And so it's, again, kind of removing that emotional response to what is happening and being a bit more logical about it.
Totally. And knee-jerk reactions can actually be detrimental to your portfolio if they are not strategic and well thought out. So to your point, you might actually just go, I need to do something, and then make a hasty decision, which could actually be massively detrimental. So you go, Gabby, go.
I just such as like fixing interest rates. I think a lot of people are considering that at the moment. They're going, shit, rates are just going to keep going up and up and up, which perfect knee-jerk reaction would be, I'm going to fix all my rates because I just think it's going to keep going up and I'm freaking out, so I'm going to do that. But, there's downsides to fixing your rates if you're going to continue to build your portfolio over the next few years. Like there's massive break fees over that if you need to, refinance and break that agreement over the next few years. So it's like, that's something that I can see really obviously people maybe emotionally knee-jerk response to these interest rates over the next couple of years.
Yeah, totally. There's also other ones. There's either like, oh my God, I need to start selling properties.
Yeah.
I mean, like people might be like, they're no longer cash flow positive.
Yeah.
I need to sell them, right? But the reality is maybe you've got an asset which is going up by $50,000 a year, but it's gone negative cash flow by $2,000 a year. And it's like, okay, well, it's still making you 48 grand a year. Is that a good thing to have, or is that a bad thing to have?
Yeah.
And so, but there's also another one, which is actually more in action, right? Because as we've already mentioned, 53% of suburbs are still going up in Australia. And in fact, we're only investing in the top 1% anyway. So, if you happen to be working with Dashdot, you're going to be in the best suburbs anyway. So whatever. But so you're going to get growth and all of these other kind of things. And choosing nothing is also making a choice, right? Nothing is not nothing. Nothing is a choice, right? And I heard this great quote. It was from a business guy, and he was talking to business owners and whatever. And he said something along the lines of, every year that you don't make $1 million is a year that you've lost $1 million, right? Because you've lost that time to be able to create that capital, right? And so I was like, what a cool way to think about opportunity cost and time. Like that money you didn't make today, that's money you lost, right? Because you could have made it and you didn't make it, right? So this is an interesting thing. But there's some interesting ways that I think we can talk about combating this kind of stuff as well. And like, how do you think about like what the appropriate strategy is for you, depending on where your portfolio is at, depending on the size of the problem that you are trying to solve? I think that there are multiple ways that you can do it. To your point about fixing interest rates and potentially stalling your portfolio at the same time, depending on your position, of course, right? Depending on your financial position and your borrowing capacity and all of this other kind of stuff and everything like that. One interesting and counterintuitive way that you can fix negative cash flow in your portfolio is to buy more assets, right? And this is a really interesting. I actually quite like this one, right? Because
Of course you do.
I like it because it's counterintuitive and also really freaking good, right? Because one way that people might think to reduce negative cash flow in their portfolio is to sell some assets, right? Relieve some of the debt burden. And the alternative way that you can think about doing it is going, okay, well, let's say I've got a $10,000 cash flow deficit let's say a $5,000 cash flow deficit in my portfolio now because of rising interest rates, or where I think interest rates might go over the next 12 months or whatever the case may be. Okay, well, what would I need to do to put another $5,000 in cash flow into my portfolio? One of those solutions could be like buy a unit block, for example, right? You could potentially if you've already got properties, maybe they've already got equity in them, and probably if you've owned them over the last few years, they probably do, right? So potentially you could go, and again, not financial advice and all of that kind of stuff. This is an idea, right? You could potentially go and, go way deeper into the pool and end up with a bigger and better boat, right? So you could actually go and buy another asset, which will give you the cash flow you need to offset any of the kind of downside risk, which is, I think, a really cool counterintuitive strategy, because not only are you minimizing, or you're actually reducing and neutralizing the cash flow risk, but you're actually expanding and growing your portfolio, which, you're going to end up way further ahead. Because times like this, thinking counter-cyclically or counter to the popular opinion is actually usually where most of the success happens, right? And there's some really interesting, crazy good stuff out there. We actually just, for those of you who follow along, would probably understand that we have a huge data science team, and we do lots of data and research and whatever, and we've built algorithms to identify the best suburbs to invest in and all that kind of stuff. What we actually did recently is we flipped our algorithms and all of our machine learning models and stuff onto the unit market. And there's some amazing opportunities out there for buying like whole unit blocks. It's so cool, right? And so therein lies an opportunity to expand and not contract. And if you think about times like this, uncertainty, look, and I don't want to use the big scary R word, but if you think about like times where there've been economic uncertainty, times like the GFC, times like when COVID hit, stuff like that, right? The people who made the biggest gains are the people who expanded, grew during that period when everybody else contracted. And so this, I think, could actually be a really interesting and counter-cyclical play.
Can I just pull on that unit thread for a sec? You said unit blocks, but is it also an opportunity for people to think about actual individual units?
It's a good question. The short answer is yes. Is it an opportunity for people to be able to consider that? The short answer is yes. The slightly longer answer is the downside with buying individual units versus buying a whole unit block is that you have significantly higher holding costs and significantly less overarching rights on the asset. So because you have body corporates and strata fees and all of these other kind of things, you can ostensibly get a good yield, but then a lot of that yield can be eaten away with additional costs. The classic thing with an apartment is you own the air inside. You own the air inside the building, but you don't own any of the building and basically none of the land. Yeah, some people would argue you own like a fractional portion of the land, but I mean, the reality is it's significantly inhibited. But if that was your only option, could that be an option? Yeah, I mean, it could be an option, right? But versus buying a whole unit block, which a lot of people think, well, a whole unit block, that's like billions of dollars or something. Depending on where you're buying, you can get unit blocks for, I don't know, probably as low as like $500,000-$600,000, which is still a lot of money. Don't get me wrong. I'm not trying to like be blasé about cash, but it's actually probably more affordable than a lot of people think, depending on where you're buying. And there's not that many of them, right? So this isn't something that everyone can go to, right? But there's cool assets out there which can really offset these kind of cash flow risks. So yes, you could consider. I think actually, to answer your question a little bit more deeply, I think the more things you consider, the better, right? I think the whole idea here is that you should be adaptable and operate from a set of principles. And the set of principles should be like, how do you optimize growth and cash flow in your portfolio? How do you set yourself up for a life of freedom, choice, and abundance? How do you make choices that are going to be aligned with that whilst minimizing risk along the way and help you to get to your goals sooner, right? So the way that I approach everything is usually that everything is on the table as an option, right? Yeah. Then you apply deductive logic to work out what is the best solution based on the set of circumstances and the environment that you're in, all of that kind of stuff. That is kind of the approach, because there's a million ways you can do it, but you have to really assess what the real impacts of those kind of things are. Personally, I'm a fan of unit blocks because you own the whole asset. You can do away with body corporate and strata. It's kind of like a big house with multiple incomes. Like, it's pretty cool.
Yeah, and again on that deductive logic, like you need to, if you're in a situation now where you need to consider the impacts of, like, you're in a like problem kind of challenging situation where you're like, how do I improve my situation here? My cash flow is being squeezed. What can I do? You do want to start with that brainstorming approach of like, what are all of the possible options, and not put your own biases, or even like what we've talked about in the past. Like, you just put everything out on the table and then work back from that. Go, that doesn't make sense because this doesn't fit me, and I don't align with that, and those kind of things. Yeah, I was just thinking about the units because I know like unit blocks, that 500,000-600,000 might still be out of reach for people. So I'm thinking more of like at a lower price point if people are struggling with cash flow. Noting as well, like the downsides that you just mentioned, and historically less capital growth on units, generally speaking, standalone units. But if the strategy is I need to add a massive cash flow asset into my portfolio, and I can only afford, 300,000-400,000. Again, coming from that brainstorm perspective, like that might be something to chuck on the whiteboard and sit with.
I wholeheartedly agree, right? And so the best strategy is the one that gives your portfolio what it needs at the time it needs in order to continue to move you towards your goals. That's the best strategy, right? And that's the adaptability piece, which is why we've never been super dogmatic of like, you must buy properties and add granny flats to them. That's the way to success. It's like, I mean, that's a thing that you can pop in there for sure.
We could have crushed it if we did that. We're the granny flat guys.
The granny flat guys. But
like granny flats.
But it's really about going, okay, what does my portfolio need, right? And at times your portfolio is going to need growth, right? And maybe during those growth phases as well, you can stomach a little bit of negative cash flow. Because I would say as well, right, it's not all about cash flow, right? It is all about actually what is going to get you to your goal, right? As much as we talk about having cash flow positive properties and everything, that's actually kind of like there's a bigger game that is being played, and that is, how do you get to your destination? How do you achieve a life of freedom, choice, and abundance? And what does that look like? And so one of the ways I think people can go wrong in this environment is looking at a property which is ostensibly a great property in a great area, which is going to grow fantastically, which ostensibly still has a really good yield, five, 5.5, 6.5, 7% yield or something like that, but may not be cash flow positive on P&I or some other factor like that. And therefore people go, well, it's not cash flow positive, ain't buying that. Thanks, interest rates. It's like, well, I think you probably need to look pragmatically at what the opportunity actually is there. When the national average yield is like 2 to 3%, right, and you're buying something that's like 5.5 to 6% or something like that, you've got to remember, like, actually, this is a unique opportunity, right? And so the environment has changed short term. That doesn't mean that you should reject good opportunities short term, because you should be playing a longer game. Back to the point that I made earlier, that asset may make you 50 grand in a year, but cost you $2,000 in negative cash flow, but you're still going to be $48,000 up, right? And so turning down $48,000 for the sake of or turning down $50,000 for the sake of $2,000 is a really bad way to build wealth. Like, that just does not make any sense. But people can get fixated on short-term metrics without thinking about what the macro environment looks like. Because the other point that we've got to remember is that interest rates won't stay up forever. Historically speaking, they have gone up, and they've gone up plenty of times in the past. And they've gone up a lot in the past. There's been times where they've gone up 3, 4, 5, 6, 7% in a very short period of time, right? And I don't believe we're actually going to go that high, right? But they typically only go up for between a year and 2 years, which is why I'm so confident when I say I don't think we're going to have high interest rates in 2 years' time, right? So these things are short-term situations that people really need to consider. And then you could actually go, okay, well, what if that was the opportunity in front of me? If someone said, it's fairly, let me rephrase that. If I believed I had a fairly good, if I believed it was fairly likely that I would make a significant return over a 12-month period, but it may cost me short-term in cash, what would I need to adjust in other parts of my life or in other parts of my portfolio to make that decision still viable? Because I know that the upside is significantly better than the downside risk. And that's how I think people should be thinking about it. That comes down to cost of living stuff as well, which we can talk about in a minute.
Yeah, I was just thinking about the cash flow piece. Like, to be transparent, like we've definitely made a rod for our own back here, where we've historically really harped on about cash flow and how important positive cash flow is. And it definitely is, but it's something to consider. Like in that P&I situation that you just explained, like somebody gets an opportunity to purchase a property and, it's $2,000 cash flow negative because they're paying P&I. Whereas if you consider if you're choosing to pay P&I in this environment, you're probably going to struggle to get positive cash flow, like net positive cash flow. Whereas if you took out the principal repayments and you're sitting on just interest only repayments, you could end up net positive. And so just that consideration, like, is this the right environment for me to be paying principal? And yeah, I was just thinking, like, I think we've definitely in the past, because cash flow is so important, but the thing about all of these principles is they only ever apply if they're relevant to the current environment and the current economy and the current strategies that suit you. So yes, wherever you can, shoot for positive cash flow. But as you said, like if the end goal is that you're still going to have this asset that grows amazingly strongly, like, can you stomach a little bit of like net negative for a year or two, or however long it takes to kind of put some other strategy in place that gets it back positive? Yeah. And so I think just particularly on that like P&I piece, like, is that an option that you can consider instead of having this belief that you need to pay down the principal all the time, because a lot of people still hold those beliefs. Consider, could I do interest only in this environment? That could be a tactic that you can test out.
I wholeheartedly agree. Now, there's reasons that people might do P&I. You can actually generally often get more borrowing capacity if you do P&I versus interest only and stuff like that. So it could be an opportunity to allow people to move forward and then be like, well, I can choose to buy a property, but I have to do it on P&I, or maybe I just want to, or whatever. The thing to remember about P&I is that is profit that you're putting onto the balance sheet, right? So the way to think about it, right, is effectively the bank owns shares in your business, right? Right? They own equity, right? So if you go and buy shares in a company like BHP, what are you buying? You're buying equity, right? Mm-hmm. So they own equity in they own like the majority proportion of equity in your asset. So what you're saying is that I want to buy back shares in my asset, right? And so typically the way you want to do that is you would really want the asset to produce enough cash to be able to buy back its own shares without putting your hand in your pocket. But if you're choosing to buy back that equity at your choice, right, then that may be cash out of pocket, but that is not an expense. That it's not an expense. It's an asset. Yeah. You're actually if you're negative cash flow $2,000 a year because you're on P&I versus interest only, the way to think about that is not like, whoop, I'm losing $2,000. It's actually, I'm actually reinvesting $2,000 in buying back more of the asset. I'm actually increasing my equity stake in the asset. So it's that in and of itself is an investment, right? And so I think that people get lost in it. They're like, well, the mortgage costs a lot of money and I've got to give all this money to the bank. It's like, actually, the
cost is the interest.
Yeah, the cost is the interest. The principal payments are you just buying back the shares and buying back the equity in the asset. So you're increasing your net worth and your net asset base, which is something where I think a lot of people forget. But I'm mindful of time. What other tricks can people do to actually think about increasing cash flow in their portfolio? Because I think this is a really good one, right? So how do we buying unit blocks is great if you can kind of do that thing. But what about actually some real strategies? So we've kind of talked about potentially looking at your loan structures, right? That's a good option, right? So maybe thinking about should you go to interest only in a high interest rate period so that you can mitigate some of that downside risk of cash flow. That's a good one. Another one you could think about is actually potentially doing a value add, right? So there might be an opportunity on your property. And of course, if you've got tenants in the property, you may need to wait to the end of the lease, or you may need to, there's obviously, stuff around this, but potentially you could actually do a small cosmetic renovation, right? Which may only cost you $10,000 to $15,000, which is a significantly less money than buying another house. But in doing so, you could actually increase the rent on that asset and get more rent for the same asset and actually recoup some of the costs and then offset some of the rising interest rate costs. That's one way. That's good. What do you think about that?
Yeah, and again, it's coming back to that, doing a recce of where you are at, including like what is my total cash savings sitting in the bank right now? Because then instead of holding on to that, you can think about how do I deploy that in a way that is going to return and improve my cash flow, such as a small cosmetic reno, or if you've got a bit more cash, like, do I want to do a granny flat? Like, considering everything with the building industry right now as well, like, don't just go and do that because that might take a bit of time. But thinking about these little ways that you can improve the asset so that you get more out of it using the asset that you currently have, which is your cash savings. And I think that also comes down, going back to the P&I piece. It's like the P&I, like you said, the P part of that, the principal part of that is you reinvesting into the asset, almost forced savings. And so in this environment, perhaps savings is not a priority for you if you're trying to maximize cash flow. You're just trying to make sure that, okay, now is not a time to be building my savings when my cash flow is being hit. So thinking about how do I actually retain what I can and control what I can and deploy it in better ways that is going to improve my cash flow. Yeah, so that comes back to the value adds piece. Like if you can do something small with the assets that you have being cash, that's definitely an opportunity that people can think about.
Totally. And another thing you mentioned, like you talked about like forced savings there, and that kind of jogged my thoughts on savings in general, right? So right now, the interest that you'll earn on savings in the bank account is really low. It's like whatever the cash rate is, 1-2%, right? Pretty low. Yep. But the cost of debt is actually pretty high, right? And so when the cost of debt is high, you can actually think about investing in debt as investing in an asset as well, where you're getting the same return as the cost of debt would be. So two ways to think about that, right? So if you've got a credit card, for example, and let's say that's got a 20% interest rate on it, if you owe money on that credit card, every time you put $1 on that credit card and pay down that debt, you're effectively getting a 20% per annum return on the dollar that you put in on that card, right? 20% per annum is a pretty bloody good return on capital, right? A pretty bloody good return on cash, right? You're not going to get that in a share market typically, right? So that can be a really cool way to go, ooh, where have I got debt liabilities? And what is the cost of that debt? Because that is, if I pay that debt down, I am actually earning that return on my own money by inversely taking that earning potential away from the creditor, right? Or the lender, whatever. So another way to think about that actually is a really, really cool one, right? Because if you've got offsets offset accounts on your mortgages, on your investment properties, on your home or whatever, you can actually push all of your savings into your offset accounts, right? Because that is actually going to reduce down the cost of your repayments. And you're effectively making a return on your capital that is the equivalent of the interest rate that you're getting charged, right? So one of the best ways to offset cash flow deficits is actually if you've got savings sitting in your bank account, it's effectively doing nothing. Inflation is actually eating that away. So whatever the capital return that you're getting on that could be a couple of percent. Inflation is currently 5-6%, whatever the case may be. So you're actually in real returns going negative on your cash, right? So it doesn't make sense. However, you could push all of that cash into kind of debt replacement strategies. So put it into an offset, for example, and you're going to effectively be making the cost of the interest rate back as a return on capital, which is really, really smart move. And so I think in the last episode, we mentioned our portfolio had gone like slightly negative by whatever, a couple $100 a month or whatever. And so we did exactly that. We said, okay, cool. Well, where's all our cash? And just started throwing all of that into the offset accounts to offset that downside. All good. And in fact, I know a lot of other people. I've spoken to probably 2 or 3 other very successful investors who've done the same thing. They said, yeah, cool. We've got all our cash sitting in offsets. So wherever we see one of our properties, they track all their financials of their properties really, really closely. Wherever we see our properties might be going a little bit negative, we just top that up with a bit of cash and an offset, and happy days, we're all good. And so that they don't really need to worry about it, which is another really, really good strategy.
Yeah, that's funny. That actually reminds me of a video I saw of Warren Buffett a couple of weeks ago, where someone had come to him with like $5,000 or something, asking, hey, what can I do? How can I invest in this? And he said, well, do you have any debt? And she said, yes, I have a credit card, but it's got 17%. He's like, put your $5,000 and pay down that credit card, because nothing I can do is going to get you 17% returns. So it's that same mindset of like, if you have a debt that you pay 17% on, it's the exact same impact on your cash. At the end of the day, it's your cash that in either situation is being affected. So you're better to pay that down rather than trying to chase some 17% return outside of that. So I think it's, if you have debt, like definitely consider, how can I minimize that in this environment, rather than, but in dance with, in both, thinking about the debt side, but then also obviously the investment side.
Yeah, and just to clarify, the debt we're talking about is non-income producing debt, right? So credit cards, car loans, things like that, right? Because income producing debt or debt on an asset which is going to grow is actually still good debt, right? And by the same token, if your interest rate on your investment property is 6% and you're chucking your money in offset, you're still making like a 6% return on your capital, right? Which is still pretty good, right? So what's another move that we could make, Gabi, in this environment?
I think maybe there's the element of like, you can improve the top line, right? So we're talking about how do you reduce costs and all the things, but then you think, how do I improve my rent? So we touched on doing potential value adds that you could charge a little bit more, but even like, have you spoken with your property manager to see, is there a possibility to increase the rent? Because as we know, like rents are still increasing phenomenally fast. Have you done a rent review recently? Have you increased the rent recently? Which is a tricky thing for people to think about, because it's not usually top of mind, because you have a property manager who looks after the portfolio and you just kind of trust that that's going up over time. But doing a rent review is a really good place to start with this, because they might do a rental assessment of what your property would currently get in the current environment as of today, and come back saying, hey, look, we can actually think that when we release this, you can charge, $20, $30 more. And that's, in essence, it's largely that net into your pocket after like property management fees and everything. But that's, starting at the top line of that equation, definitely something that I think people should look at.
Yeah, and we actually had a situation recently ourselves where we had tenants who'd only been in a property for like, I don't know, I'm going to say like less than 6 months, like maybe 3 months or something like that. Like they really haven't been in there that long at all. Proactively, the tenants actually requested, they said, hey, can we increase the rent? Which sounds crazy. But they said, look, can we increase the rent, but can we lock it in for another 12 months? And so they increased the rent by, I think, $30-$40 a week, which was pretty good. They said, because they could see what was going on. They were feeling uncertain. So they really proactively, and hats off to them, thought, how can we lock in future savings? I thought this was really cool. So they actually came back to us. Now, we could have, if it was less than, it's probably fair market rent for today, right? but it's going to be pretty cheap by the time the lease finishes up. And they know that too, which is why they said, cool, let's crank it up a bit, but let's lock it in for another 12 months so they've got security around their own finances. So there could be an opportunity for you to just like explore that option with your tenants or with your property manager. Just say, hey, look, we know that rents are going up a lot. We know that people are feeling a little uncertain. So if anyone wants to renegotiate their rent and lock it in for another 12 months, then we're open to it as well. It's not about going to your tenants and going, we're going to screw you, give us all your money. It's like not that at all. But there's a way that tenants and property owners and property investors can work harmoniously and synchronously together to achieve a common goal. You know, you've got to remember that most tenants are good people and want to live in a great place, great house, and you know, like we're all in it for the same reasons. So that's another opportunity there to potentially increase your rent. Cool. Any other thoughts, Gabby?
I'm just looking at your notes. I see you've got one here about blue chip playbook.
Oh,
what is something that people can think about?
All right. Okay. So this is a really good one, right? So, I want to preface this by saying this is not a strategy that I think people should go and do. However, what is interesting is people who invest in blue chip properties, like super blue chip properties, like buying properties in Bondi and all of that kind of stuff. One of the strategies that they deploy in order to be able to make up for the negative cash flow is that on the assumption that their asset grows, and let's say it grows by like whatever, a couple $100,000 a year, they actually then refinance some of the equity out and use that cash that they've refinanced out to actually pay the shortfall of the cash flow, right? Basically pay the debt. Now, it's a pretty broken strategy long term, in my opinion. Like it's not a good long term solution because you're effectively going into a doom loop of debt and serviceability, and it's not a good place to be. However, right? Could this, and again, this goes back to the idea of like putting all options on the table and then looking at strategically what is going to be the best move for you and your family and everything like that. If there was something going on in your life and you knew that you were going to really struggle with the cash flow situation, but you had a little bit of borrowing capacity available, could you take some equity out of your asset and then keep that aside to literally pay the repayments? It's an option, right? Again, I'm not advocating that everyone go and do this because it's not a good long-term strategy, but it could be a short-term strategy to allow you to release some of the capital from your asset, get it liquid, and then use that liquidity to then cover the shortfall or downfall if that's something that you needed to do in your portfolio. So that is another counterintuitive way that you could potentially think about offsetting some of the risk here. So where I think a lot of people can go wrong, though, just sort of moving on, I think we've got a good few tips there. And by the way, if you've got other tips and that you want to share, then you can email them into til@dashdot.com.au. That's til@dashdot.com.au. We'd love to hear them because there's obviously loads of ways. You can also look at your cost of living and stuff like that. But where I think a lot of people could go wrong here is changing their overarching, or actually making poor strategic decisions. And we kind of talked about that earlier. Because I know that we've had people sort of come to work with us and stuff who have said things like, well, what if interest rates go up to 7%? I need to buy a property that has 10 or 11 or a 12% gross yield, which absolutely you can buy those properties. But if that is the single thing that you're focusing on, the likelihood is you're focusing on not a holistically good investment strategy. You're just saying, where can I get that number? Right. And you could end up buying a subpar asset in a subpar location, which actually could go down in value and be a negative outcome for you overall because you're fixating on a specific and individual number versus looking at the macro and going, okay, what do I need to do to succeed long term? So I think that's just one little point that I want to put in there.
I just want to add, I think as well, like going back to what I said about the philosophies and the briefs that you kind of set for your own strategy are amazing, but they're only ever relevant if they're relevant to the current environment. So there's no point chasing 10% yields if the type of asset that gets 10% yields in the current environment is not a very strong asset, not in the right location, doesn't have good growth prospects, those kind of things. And I think just to plug what we do, like it's one thing that is really good about working with our team is because we can come to the table and collaborate on a brief for the next purchase, but it's also factoring in what are we currently seeing on the ground in the current environment that actually makes sense because, 2 years ago, it might have made sense to have this flat brief that might not actually work in the same context now. So yeah, I think just that absolutely don't get like gung ho on I need this particular yield and like screw everything else. To think about like holistically, what do I need the property to do? Do I still need it to grow? Yes, because I'm investing in property and that's what I believe is the best thing to do. But then also factoring in like, how does that work in the current environment that we're in, rather than just getting caught up in details of things I believe.
Yeah, totally. And it's also going back to kind of like the overarching premise of this episode. It's about understanding what are the levers you can pull in your portfolio in order to achieve the same or similar outcome without deviating so far from your strategy that you end up somewhere that you don't want to be. Right. Mm-hmm. And so that means looking at all of the options, including looking at your own cost of living. I know like inflation is going up. Inflation is going up. So cost of living is going up. Right. So it could be a time for you to start to consider like, okay, where are the costs in my life and do those costs need to be there? And, to borrow from, I think it's Marie Kondo, is this bringing me joy? Like a lot of the things we have in our lives don't necessarily like they're there, but they're like, if you really cook it down, it's like, is that actually something that I need right now? Is that something that is giving me joy? Is it serving me? Is it taking me closer towards my goal? Right? Because, let's not beat around the bush, right? There's a lot going on at the moment. Inflation's up, interest rates are up. It's not like everyone's gotten fat off the green pastures of the last sort of 18 months. And now we're transitioning into a different phase. And so in order to do that, you need to adapt too. You need to adapt how you're thinking about what your level of commitment is to your goals, why it's important to you, what you want to do to get there, how dedicated are you to achieving those goals? How much are you prepared to think for yourself to achieve that outcome? Right. And so and again, everyone's situation is different. For some people, it could just be as simple as going, you know what, we're going to eat out a little less and we're going to start to rediscover our joy for cooking at home. That could be one thing, right? For other people, it could be like, well, I'm paying a hell of a lot of rent to live in Sydney, for example. Could I move somewhere else where the rent is like half as much and potentially I get a bigger house and a nicer place to live, right? So then that would be geographic arbitrage to reduce your living expenses. There's loads of different ways that you can think about doing that kind of stuff without, and again, we have never been advocates of, eating beans on toast, living a fire lifestyle and, scraping everything, living like a monk, holes in your shoes, don't spend any money on anything and save every single dollar. I just think it's a shitty way to live because life should be full of joy at every moment. And you've got to find the joy sometimes because joy doesn't come from just spending money. But you've also got to make sure that you're living a life in accordance with the way that you want to live it because who knows how long you're going to be here, right? So, but you can question what that actually means, right? And then you can say, okay, well, is this still serving me in the way that it was serving me once? Am I still getting out of this what I wanted to get out of it? And could I find a different way to get a different outcome that is going to keep me aligned with my goals and allow me to move with the change of the season? Because this is a different season. And all seasons pass, right? We've been in summer, we're now, moving into a different season. And so, understanding that and adapting to the environment is I think the key to success.
Absolutely.
Cool. Gabi, anything else you want to add for this episode?
No, I hope it's been impactful and I hope that we've given you some things to, just think about, but also practically put in place and go, okay, what am I actually fearful of and defining what are the actual changes that are actually going to happen to my portfolio? What is my savings amount right now? Like how much cash do I have? How much equity do I have? What are my loans? How much do I spend on this? And then bringing in that like cost of living side of things as well. Like, oh, actually, you know what? It's been a pretty good 2 years. So my costs have blown out a little bit. I've gotten a little bit fat in my lifestyle. And I actually find with that stuff, a lot of you get quick wins even just by bringing awareness to it. I think like that's what I find personally with anything. It's like as soon as you start paying attention to something, you're like, being a little bit sloppy here with this decision. So I think, those points just like doing that assessment of like, where am I? What are all the factors that are going into this point? And then testing out some of these tactics. I think that's going to be really impactful.
Totally. Awesome. Well, guys, I hope you've enjoyed this episode. We'll leave it there. If you've got any thoughts or comments or any feedback, send it through to til@dashlot.com.au. We'd love to hear from you. But until next time, we'll see you soon.
See you.